Welcome to another episode of the Michael Yardney podcast. Today I'm going to share with you 4 lessons that you must understand as a property investor about the property cycle, particularly since I believe we're going to be entering a new phase of the property cycle early next year. I'm going to explain that to you in just a moment. Now, regular viewers or listeners would know that I usually have a guest on these shows, but every now and then I think the topic's so important that I just want to have a chat, just me and you. And that's what this session is today. So I want to share with you 4 lessons that I've learned after investing for over 5 decades about property cycles that I think are going to be really important for you to understand as well.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Today I want to share with you 4 lessons that you must understand about property cycles to take advantage of where we currently are in the property cycle. Look, our real estate market actually surprised many people on the upside this year, hasn't it? Considering how high interest rates have been and that they hadn't fallen like many predicted in the middle of the year. But many people are asking now, what lies ahead for our real estate markets? Will they keep up their momentum or will they tighten because there's more stock on the markets and investors are having difficulty? Well, not just investors, home buyers are also having difficulty with restrictions from the banks. They're starving the market of the finance that we need to grow. Now, looking back at how previous property cycles played out, as I delved back into my memory to see what lessons I could learn from past property cycles, I realised I've probably learned more from the many mistakes I've made than from the things I got right. I guess there's a powerful lesson in that itself, isn't there? Anyway, what I'd like to share with you now are 4 key lessons I wish I'd learned earlier in my investment journey about property cycles. I mean, when I first started off, I knew none of this. There weren't the podcasts, there weren't the books, and I started investing in the early 70s when inflation took off. Even though interest rates were high, property values rose, and there wasn't all this information about cycles. And unfortunately, I learned in the early 80s when there was a downturn about how bad cycles can affect property investors, and again in the early 90s when we had the recession we had to have. So I guess the first lesson I'd like to remind you is that our economy and our property cycles, markets I should say, move in cycles. And the main cause behind these cycles is that we're human and we tend to share the general optimism or pessimism of others. Now, it's a common fallacy that the Australian property cycle lasts 7 to 10 years. I know some people that say that even though there's an 18-year cycle, cycles vary in length and they're affected by a myriad of social and economic factors. And then at times governments lengthen or shorten the cycle by changing economic policies and in particular by manipulating interest rates. For example, the current property cycle commenced at the beginning of 2023 in January or February when the Sydney market picked up. First, the high end of the Sydney market in particular picked up, but that was after the fall, if you remember, of property values as interest rates started to rise in 2022. And property values around Australia in general flattened and in some cases dropped even up to about 8%. Now, we're only a couple of years into this current property cycle. And even though the markets have slowed down a little recently, I believe when interest rates start to fall next year, there'll be another phase of this current property cycle. In general, I found that property cycles are now lasting around 4 years. So I think we're still about halfway through this particular property cycle. They used to last longer, but I think just the way economics works at the moment has shortened property cycles. Look, if you look back a couple of years, some of you will be been property investors long enough to remember the property cycle which ended in mid-2017. And that was actually a prolonged cycle because of falling interest rates. And at that stage, APRA stepped in. It stepped in a couple of years earlier. It tightened the screws on lending, particularly to investors. It was concerned that too many investors were getting into the property market. And I guess at one stage, close to 50% of all home loans in Sydney were to investors say, yes, the property markets overshoot too. In other words, they move more than the changes in the fundamental influences would seem to require. But that happens on the upside, as they did on the downside in 2022 when interest rates went up a bit. But again, the markets correct themselves. So the first lesson I want to share with you today is our economy and our property markets move in cycles. And I do recognise that property values don't go up consistently. There's periods when property values stagnate, like they have in Melbourne for a couple of years, or when property values even drop. So it's important to look back over what's happened in the long term. And as I've said on a few occasions in this podcast, I see a great window of opportunity in Melbourne, which will revert to the mean in due course because it has actually gone down lower than the fundamentals would suggest. So property cycles are influenced by lots of factors, and in this case it's in Melbourne in particular due to lack of confidence in the government and how the government's affecting not just property investors but all sorts of people with tax changes. Okay, the second lesson I'd like to share with you about property cycles is that the market's usually wrong about the stage of the property cycle. You see, crowd psychology influences people's investment decisions, often to their detriment. Investors in particular, but homeowners too, tend to be most optimistic near the peak of the cycle at a time when they should be the most cautious. And then they're the most pessimistic when all the doom and gloom's in the media near the bottom of the cycle, when there's actually less downside. So market sentiment's one of the key drivers of property cycles and one of the reasons why our markets overreact, as I said, overshooting during booms and getting a bit too depressed during slumps. Remember that each property boom sets us up for the next downturn, just as each downturn sets up the scene for the next upswing. And I believe market sentiment, we know market sentiment has been poor over the last couple of years because of all the negative messages in the media, concerns about inflation, concerns about problems overseas, concerns about our politicians, concerns about will the market crash because interest rates are too high. And so therefore I believe that market sentiment is going to change considerably in early 2025 when interest rates start to fall. We're already seeing more experienced investors approaching us at Metropole wanting to get involved in the property market because they can see that interest rates have peaked, inflation has peaked, and the next step is going to be interest rates coming down. And when that happens, consumer confidence is going to improve. When people are more confident in their jobs, when some of the political and geopolitical issues are clearer, people will start making those big investment decisions. Interestingly, as the cycle moves on, buyer sentiment usually returns before seller sentiment does. In other words, buyers start to get into the market, they start looking for properties, property values go up, auction clearances go up, and then sellers think, maybe I should get in the market now and move as well. That's what happened at the end of 2020, around when COVID came and everyone was a little bit nervous and a bit concerned and interest rates started to come down. Buyers got into the market first, jumped in, even before interest rates started to fall too much, and that created that boom. And I believe early next year, consumer sentiment will pick up. But at the moment, most people, remember this message I'm wanting to give, the second lesson is most of the crowd, the herd, is wrong about the stage of the cycle. So they're worried that now the property markets are going to slow down and falter for a year or two, when I think it's setting the stage for the next stage of the cycle. Okay, the third lesson I'd like to share with you is that there's not one property market. While many people generalise about the property market, there are many sub-markets around Australia. I mean, it's not just the markets for Melbourne, Sydney, Brisbane, or all the other states. Each state is at a different stage of the property cycle, as we know. This year, the markets have been very, very, very fragmented. So Perth and Brisbane and Adelaide have been the stronger markets. Sydney's performed pretty well. Melbourne, Canberra, and Hobart have underperformed. Each state's within its own stage of its own property cycle, and then within each state there are different segments by geography, by price point, by the type of property. For example, the top end of the market will perform very differently to the new home buyers segment of the market, or the investor segment, or even the median area of the established property market. So I see next year, when interest rates start to fall, different segments will pick up. So this current cycle, which began in 2023, started at the top end of the cycle, particularly the top end of the Sydney property market. But then the lower and middle range properties picked up considerably. And if you think about it, a couple of years ago, Adelaide and Perth prices were considerably below the East Coast prices. So a lot of investors and others went to Perth and Adelaide, and that pushed up property values as well at the lower end of the market. Moving forward next year, when interest rates start to fall, not everyone's going to benefit the same. I believe that people with multiple streams of income, people with equity in their homes, people who've got share dividends, business dividends, they're going to be able to borrow more and move the cycle moving forward. The bank of mum and dad's going to be there to support people as well. And it's not a judge of people, but more working class people, people who don't have as good incomes, they're still going to be stuck for quite some time with the high-ish cost of living. So even though inflation's coming down, doesn't mean petrol prices or the prices at the grocery store are going to come down. So the cost of living will still affect some people, and different segments of the market will pick up. So I guess the message I'm giving you is various segments behave differently moving forward. I believe the higher end of the market is going to pick up first in the beginning of next year, because they're going to be the ones who are going to be able to borrow more. Okay, the last lesson I'd like to leave you in this particular podcast is that you should always allow for an X Factor. Now, when most Australians hear about the X Factor, they think about that TV talent show, don't they? However, an X Factor is also talked about in the less glittery world of economic forecasting. Economists refer to the X factor when an unforeseen event or situation blows out their carefully laid plans. Look, more recently, Nassim Nicholas Taleb, a finance professor and author, popularised the term black swan events for these deviations from the expected. Look, I first came across many years ago the concept of the X factor from distinguished economic commentator Dr. Don Stammers. He used to try and predict the X Factor for the forthcoming year in the January edition of the now defunct BRW magazine. Of course, by definition, the X Factor is unforeseen. You can't predict it. But it was a little game he used to play and then review his prophecies 12 months later. It's also a game I took up many years ago and I've had fun with over the years. Now, the X factors can be negative. It's like the aftermath of the global financial crisis or COVID, or they can be positive, like the China resources boom that Australia experienced after that global financial crisis in 2010, 2012. It can be local factors, or it can occur from abroad, like the US subprime mortgage crisis of 2008. I don't know what the X factor is going to be for the coming year, for 2025, but just let's look back a little bit at some of the more recent X factors so that you can get an idea of what I'm talking about. I mean, a big one that will stick with us for some time is the COVID-19 pandemic in 2020. The pandemic drastically reshaped global health, economies, how we worked, urban dynamics, the work from home, the remote work became a standard. Supply chains were disrupted. A massive acceleration in digital transformation occurred in all sectors. Zoom, everyone started using Zoom. So out of the blue in February 2020, all of a sudden, something that nobody planned. And so all the assumptions we'd made about where the property market was going, what's happening, were thrown out of the water. I guess the year after that, in 2021, 22, all of a sudden we had global supply chain crises, partly spurred on by the pandemic and geopolitical shifts. It disrupted all sorts of things, led to a shortage of goods ranging from electronics to cars, and that sparked inflation. And that's one of the things that no one really saw coming, well, until some economists looked back and saw what was happening and it happened in the past. And in many ways, I guess it was predictable with the money creation that the governments all around the world did to help stop us going into recession from the COVID pandemic. But what I'm going through is just a couple of the X factors that came out of the blue that I guess we didn't know was happening. Maybe you want to play the game. What's going to be the X factor for 2025? I guess another factor that was an X factor that affected all of us who are interested in property over the last couple of years was the significant interest rate surges and inflation that occurred in 2021, 2020, well, up until recently, really. Now, again, no one really talked about inflation for over a decade. In fact, our Reserve Bank kept lowering interest rates in the decade before COVID because it was trying to push up inflation, bringing inflation to its range of 2 or 3% that the Reserve Bank likes us to keep inflation at. So interest rates were low for well over a decade and kept falling, which was very good for our property markets. And then the X factor was a significant surge in interest rates and a long period of inflation. I mean, that spiked globally, but it led central banks around the world to raise interest rates quickly. Australia was a little bit slower than other countries to do this, but this surprised many who'd grown accustomed to a low interest rate environment. It affected our housing markets. It caught a lot of mortgage holders off guard as their mortgage payments became high. Remember all those stories about interest rate cliffs, fixed mortgage cliffs? There were commentators out there telling us that the property market was going to crash because of that, and then because of government debt. Well, those things fortunately didn't happen, but yes, the X factor that scared some of us was the interest rate surges and inflation. Another interesting X factor that played out over the last couple of years was the rise of artificial intelligence and ChatGPT. I mean, AI breakthroughs, particularly in generative AI like ChatGPT, are starting to transform industries, starting to automate sectors, and it actually sparked a debate about job displacement, regulation, and of course now ethics. How's that going to play out over the next little while? While it hasn't affected our property markets, remember, I'm just talking about X factors that affect our economy because our property markets clearly don't work in isolation. Similarly, out of the blue in 2022, there was the Russian-Ukraine conflict. Who would have thought that would have lasted from then until now? The invasion of Ukraine reshaped geopolitical alliances, energy markets, pushed up the price of oil. It changed strategies in Europe and accelerated the shift towards renewable energy because a lot of Europe was dependent on the Russian gas. And of course, now we've got the terrible Middle East crisis as well. And so there are uncertainties there. And the world is uncertain about, when we are uncertain about economic issues, we tend to just be a little bit more cautious. Another, I guess, X factor, if you think about it, was the work from home revolution. I mean, initially it was a response to the pandemic. We started to work remotely or hybrid, but that's now become a lasting change, and that's impacted commercial real estate markets. It's actually impacted office buildings because many of them got empty spaces, empty floors, and values of office buildings have dropped considerably. It's also impacted urban planning, how we want to live. We're now wanting bigger accommodation and we're needing a media room, a Zoom room, or an office. It's no good doing your work in the kitchen table anymore. It's also changed work-life balances. So that was an interesting X factor as well. If you go back just a little bit earlier, a big X factor for 2019 was the miracle election of the Morrison government. I mean, it wasn't that long beforehand that commentators were forecasting a prolonged property slump, assuming that the Labor Party would win the federal election. Because if you remember, the Labor Party at that time were talking about changing negative gearing and changing capital gains tax. Hey, that's happened again this year, hasn't it? So I guess these X factors affect the economy at large, which of course affect our property markets. But our property markets have their own specific X factors, unforeseen events that lay the best plans and predictions to rest as well, like APRA's unprecedented restriction of bank lending to investors starting in 2014, 15, 16, that made things much more difficult. The current lending environment is nowhere near as friendly, especially to investors who want to grow large portfolios. So the lesson is, while it's important to take a long-term view of our economy and our property markets, you also need to allow for uncertainty and surprises by only holding what I'd call first-class assets and diversified over a number of different property markets. So I think that's actually something that's been happening a lot now anyway, that more people are borderless investors. In fact, at Metropole, while we have our own teams in Melbourne, Sydney and Brisbane, a lot of interstate clients and overseas clients are now buying in the Melbourne property market, seeing that there's an opportunity where Melbourne is probably at its stage of the property cycle where Perth and Brisbane and Adelaide were 3 years ago. So I'm not suggesting it's the only place to invest. There's going to be great opportunities elsewhere as well. But the point I'm making is understanding that there are going to be X factors, black swan events that affect you. You should only hold top quality properties. Now, I know there are some people out there who say, no, you should actually, rather than buy one good property, buy 2 or 3 properties, cheaper properties, and diversify, be in different locations so that you're not as affected. I would disagree with that. Your job as a property investor, depending, well, I don't really know what stage of the cycle, your property journey you're at, but most beginning property investors, their job is to build an asset base so that in the future they're going to be able to get the cash flow they want to enjoy their lives. But many investors start off by buying cheaper properties because there's a bit more cash flow involved. But there's no doubt that during the last couple of years, regional areas and first home areas and cheaper properties have actually strongly outperformed. But, well, not strong, but outperformed. Now, I mentioned to you a while ago that I think in the next stage of the cycle, when interest rate falls, it's the upper end of the market is going to do well. But if you take a big picture, long-term view, there's no doubt that the more affluent and gentrifying areas where people have got more money, where people have got more stable jobs, where people are not just 1 or 2 weeks away from broke, are going to outperform in the long term. And it's not just because owner-occupiers are moving in there and holding up property values. It's not just because these areas are gentrifying and more wealthy people are moving in, but it's also because the tenants in those areas are not 1 or 2 weeks away from broke. Remember, not all tenants are tenants because they're poor. Tenants are often renting because of the stage of the life they're at. They just got married, just got divorced, just moved from overseas, just moved from interstate. Are they renovating their homes? So a lot of my tenants, because of the sort of properties I own, are very wealthy and often rent investors. They got in properties elsewhere that they own, but are renting in the accommodation that Pam and I own as investments in great gentrifying suburbs of Australia. So the point I'm making is that rather than owning a couple of cheaper properties, I'd rather you own good quality properties, because in the future, your income as a property investor is going to be dependent on your tenants being able to keep paying rent and keep paying higher rent over time. So that's why the concept of owning fewer quality properties, quality over quantity, is the right way to go. Now, I know there's some people out there, especially a number of the newer buyer agents, who say, buy 2 cheap properties because they get commissions on 2 sales. I don't believe that's the right way to do things. You can't get A-class, top-rated returns buying secondary properties. So my suggestion is, if you want to take advantage of the next stage of the property cycle, which is going to start early next year as interest rates start to fall, and if you want to get in before the crowd, before FOMO kicks in, why not have a chat with my team at Metropole? Why not have a complimentary wealth discovery chat to discuss your options, whether you're a beginning investor just starting out or a more experienced investor just wanting to see how you're going to go. Now, You've heard me say before that the property you eventually buy should be the physical manifestation of a whole lot of decisions you make and make in the right order. So while a lot of people come to us and say, where should I buy or how much should I spend? That's right at the end. What we want to understand is where you are, where you want to head, what your risk profile is. Are you going to stop and have babies along the way or go overseas for a year or two? And then we help you build a strategic plan. We help you become the person, we help you plan to become the person you plan to become. Planning is bringing your future into the present and doing something about it. So a plan will tell you what to do, but just as importantly, what not to do. Then if you allow us, we'll help you implement that plan. I guess what I'm trying to say is we're much more than just a buyer's agent. Our job is to help you outperform the markets. Interestingly, a recent survey of the results of our clients showed they're 7.3 times more likely than the average investor to own 6 or more properties. I guess they've made the right decisions because they were given the right advice. Now, I don't know what you're going to achieve, but why not go to metropole.com.au and have a chat with one of our wealth strategists to discuss your options. It's obligation-free, and it may be a bit late in the year to do something now, but why not get your ducks in a row? Because next year, I believe there will be a resurgence of our markets because interest rates are going to fall and confidence is going to return. So the best is yet to come. And there were 4 lessons that I believe all property investors must understand about our property cycles, because the cycle will move on, and the areas that are done very well over the last couple of years are going to start to slow down as those suburbs and those locations, and particularly those states, and in particular Melbourne, which has underperformed, is going to catch up. That's just how the property cycle works.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to explain to you that, as I see it, there are 3 states of happiness. If you look closely, I think there really are 3 ways of being happy. The first 2 are accessible in everyone's life, but the third one is rare. But as I see it, the third way is the only one that stood the test of time for centuries. Now, the first way to be happy is to follow impulses. Take life as it comes from moment to moment. Of course, this is the way of babies and small children. They're motivated by the next thing that occurs to them, and they've got little ability to predict what will turn out, whether it's going to be a good or a bad experience. Now, this impulsiveness often lingers on in many adults, but the vast majority of people move on to the second way of being happy. As I see it, the second way of being happy is to seek experiences that bring pleasure and minimise the sort of experiences that bring pain. Yet no matter how carefully you assess every situation, we often end up in relationships that have soured or things that once excited us that become boring. But psychologists have discovered that people are generally bad at predicting what's going to make them happy. Interesting about that, isn't it? Now, the third way to be happy is an eternal way, and it's independent of the first 2. The third way is a state of being, and it requires conscious effort. It happens when we make choices. It happens when we make choices of peacefulness over violence and anger. We make the choice of acceptance and tolerance of others rather than being annoyed by others. It happens acting out of love and kindness and generosity. The third level state of happiness is when you devote time to your creative endeavours, to being of service, to being altruistic, to being independent of good, bad opinions of others, not worrying about what they say, not adding to your own stress or stress around others. And as I see it, the third state of happiness is also speaking or living your own truth. So the mindset message I want to share with you today is it's important to recognise that the state of happiness is awareness rather than a planned or predictable outcome. And that frees you from all attachments. I think it was Deepak Chopra who said, being in a state of awareness spontaneously puts you on the correct path in every situation. So ironically, the third way completes the circle. Because you're following your impulses as they arise, just like a child, and taking life as it comes, the difference is that you're choosing to be in a state of childlike wonder rather than being reactive to it. Poet William Blake stated in his called this state organised innocence. I understand that in Buddhism and other Eastern traditions, it's called choiceless awareness. Choiceless awareness allows you to arise above the ego level, where you predict pleasure and pain. It gets you to rise to a state where there's no dilemma, because every situation is meant to be for you to experience. So according to ancient wisdom, there are many routes to this third way, including meditation, mindfulness, self-reflection. Now, don't think Michael's gone all woo-woo on me, but I think these practices can mean that you're going to be eternally happy. The important thing to know is you're not forced to choose between the first and the second ways either. Knowing that they're not going to lead you to lasting happiness, no matter how hard you try, it's the opening to the third way that could emerge. So your intentions set the path in motion and unfolds every step along the way. I think that's a pretty important lesson for you in today's mindset message. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?